Hello, fellow investors. Welcome to another episode of Ritter on Real Estate, where we teach you how to passively invest like a pro. Today, my guest is Jake Clopton, and Jake founded Clopton Capital back in 2010 and is an active commercial mortgage broker. And he's got an extensive background in commercial finance and interest rate markets. He serves as the company president and head mortgage broker and personally oversees each loan arrangement. Jake has personally negotiated hundreds of millions of dollars in real estate loans and advisory work. So, Jake, excited to have you on the show today.
Yeah, likewise. Appreciate you having me on. Thanks so much.
Yeah, I think this is good timing. I think I feel, I guess, from my side of the fence that a lot of things have changed in lending over the past year or so. I think just as a function of prices and things and interest rate expectations. And I guess what I mean by that is I feel like people are taking different loans today than they were maybe a year or two ago. So excited to kind of dig into some of the changes and different things that are going on. But before we jump in there, let's step back for a sec and, let's just give people a sense of who you are and kind of where you came from and how you got to where you are today.
Yeah, that'd be great. Absolutely. I started this company back in the 2009-10 era, right? Before I started doing commercial real estate loans, I used to trade like interbank hedging product futures, just a fancy way of saying, LIBOR and Fed funds, stuff like that. And then, 2009, everybody knows what happened, financial crisis, and interest rates went to zero. And you kind of need things to move around to make money trading. So I was, really looking for, new opportunities. And at the time, right, I mean, it was a financial crisis and, there was no lending and people were having a really difficult time getting anything done. So my idea was to create a business around helping people find capital. Here we go. Fast forward, right? Almost 13 and a half years later. We are very focused on the commercial real estate space. I'd say we do somewhere around, 200 million bucks a year in financing of one way or another. And, we do all asset types, multifamily, definitely. And we'll do perm, bridge, construction. And we actually get involved in some joint venture equity arrangements as well. So, definitely in the markets, kind of up to our necks in commercial capital. That's kind of our backstory.
Yeah, that's awesome. You found a new opportunity, built a company, and now here you are doing over 200 million a year in loan origination. So that's fantastic.
Yeah. And I didn't really have candidly a background in real estate before I started, right? I mean, I love real estate. It's extremely interesting to me. And the way we got started is, to be honest with you, Ken, I just started cold calling lenders and banks and creating a network. And honestly, the value that you bring to the table in this business, as almost any business, is really your network, right? And the relationships you can build. And that's how it all started, right? Just pick up the phone, putting the network together and finding the people that at the time were actually lending.
Yeah, I'm curious when you're making those cold calls, and just even today as you make new relationships. I mean, obviously there's a lot of different mortgage brokers out there. I mean, what are the lenders looking for when they say, okay, this is a guy that we're going to take seriously?
Yeah, I mean, at the time, most people were actually getting out of the business, to be honest. So it's a great time to actually start. It's kind of like what I was telling some people, when the pandemic happened, all the restaurants are failing. I was like, actually, it's probably the best time in history to start a restaurant if you can do it the right way, right? Your competition's all gone. I mean, it's just kind of like anything else, though. I mean, you've got to understand the terminology, know what you're doing, and just, the number one rule is just not wasting anybody's time. Right. I mean, because, people in commercial lending, they all kind of, for the most part, work off of a commission base, based on how much volume they're doing and stuff like that. So, obviously time is money and precious. And, that's really what it comes down to, is being effective and efficient at building relationships and also keeping, respect to other people's time. That's what really helped me to build the network.
Gotcha. So were you just presenting them and saying, hey, I've got a network of folks over here who need loans. I can bring them and I can bring them over to you. And is that really the value prop?
Yeah. I mean, at the time during the financial crisis, it was almost even simpler than that, right? I mean, if you found, the lenders that were lending, you know, and if you were able to go out and just kind of, say that you had that, people just came to you. You know what I mean?
Yeah, sure.
But that was the idea, right, behind the whole thing, is that there was kind of that desperation in the market that people needed lending in some way, and it was a financial crisis, right? And that the scarcity was the scarcity of liquidity. You know,
Yep.
The last, right, the pandemic was totally different. It wasn't a financial crisis. Actually, there was lending the whole time. It was that the other side of the equation, like, there was so much uncertainty that people, were being very conservative, and there was things that were happening that have never happened before, right? Like, how do you underwrite, some deal that was shut down because of, lockdowns, or how do you underwrite a multifamily property where none of the tenants are paying because they don't have to, right? So it was just very, very different how this crisis went versus the last one.
Gotcha. And even in the COVID, during the pandemic, I mean, are you, in your role, are you helping kind of bridge that gap of helping the lenders kind of see, like, hey, here's here's how we might look at these things, or tell the story on the property, and help get that loan through?
Oh yeah, absolutely. I mean, so the way that we operate, right, is, and maybe some firms don't operate this way, but the way that we do is a little bit more of a, I would say, relationship-based approach, even with our capital sources, right? So what my main goal is for the capital source side is to understand, like, realistically what they need to return to their own investor capital that they've raised, and they're lending out to try to make money on, right? I mean, that's the whole game, right? So if you can really understand, like, their business strategy and how their capital is formed and what they need to return to their fund, then you can kind of tailor what you bring to them. And my goal during the pandemic, and a lot of these, properties that we're seeing that were challenged, right, was to present, basically the advantages and the positive points of those properties to the lenders, knowing, like, areas where they would be able to deal with that, right? And a lot of times, like, it's not so simple as just shooting an email with a loan request, right? I mean, it really takes some, some face-to-face time and really talking the deal through a lot of times to get the deal through, especially when it's challenging, right? Because if you think about it, at the end of the day, like, to get denied, all somebody at the lender has to do is just say no. And that may happen whether or not it would have actually been a fit for them. So, I mean, yes, there's definitely an idea of kind of pushing it through and helping them see the light, for the scenario, rather than just shotgunning it out and saying, hey, here's a deal, and having a bunch of people say no and just accepting that.
Gotcha. And so, from when you started to now, I mean, how has the company evolved?
It's gone through, probably a couple iterations. When it first started, it was just me, right? So I was an independent broker, and then, started building a company around that, right? So, probably a couple of years in, I started probably more of a traditional type of brokerage structure where, I built out, people underneath me, and, like, a bunch of originators that were also reaching out to people and trying to find loans, and they almost end up, those types of sales, like broker positions, almost feel like little franchises of yourself. You know what I mean? Because they're also kind of running their own little business.
Mm-hmm.
I learned very quickly that I am not probably built for human resources. Just not my thing, right? So, in managing that many originators, I mean, I wanted to go a different direction than just a traditional model. So what I actually ended up doing was, after about 6 years in, moving away from the sales originator guy role, right, where you have all these originators who don't really know the lenders that well. They're just out there churning and burning, trying to find loans. I moved away from that to building out more of a back end that I think works much, much better and more efficiently, right? So I built out a whole back end support staff, really kind of around what I do and what, a couple other people do. And what that allows us to do is do more business for each person, but also allows me to see both sides of it, right? So instead of having these very specialized roles, what I can do is I can talk directly to the borrower, have that FaceTime there, really understand what they need. And at the same time, the exact same equation for the lender side, right? So it's, it's me in the middle, knowing, intimately both sides of the equation. And that works so much better to try to get these deals done versus just having the prior, structure, which was you have a loan originator just out there trying to find deals. And then you have somebody that deals with the capital markets. I would say probably 95% of firms are like that. And I've found the way that we do it now is so much better for everybody. You don't shotgun deals out. When a deal comes in, I pretty much know where it's going already. And if I get any pushback from a lender because of it, I'm like, no, this deal fits you because of yada, 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 right? And we'll get stuff done that otherwise wouldn't. So that's the biggest iteration and difference of kind of what's happened. So.
I think that's interesting. I mean, so instead of focusing on hiring a bunch of originators, you basically have just created leverage points for yourself and some of a couple others to the back office staff. So you can spend more time doing what I would call kind of your highest and best use, right? Spending time with the lenders and also spending time with the folks that want the loans and being able to bridge that gap and really tell a good story there. So you're able to spend more time in your, kind of in that space you want to be in. So I think that is unique.
Yeah, that's right. The industry today, candidly, unfortunately, maybe fortunately for us, but unfortunately, I think for the industry in general, is actually moving even more so in the direction of what I would say is the more inferior model that we moved away from, right? So if some of these shops, you hear everything today, right? Oh my, we're technology, or we have AI, or this, that, and we're moving towards more like almost like a guaranteed rate type of deal, right, for the commercial space, which I don't think works at all. I think it's a horrible idea. And realistically, what that's doing is it's creating even more of a disconnect, right, between the borrower and the lender side. I mean, you have even less of a relationship there, right? Yeah. And like it can work well for the residential space where lending is very boxy and a house is a house, right, to a degree, right? And you have government agency programs. There are government agency programs, especially for multifamily, as we all know, Fannie, Freddie, right? I mean, they do have box to a degree, but what it's missing, even in the most structured and boxy type programs where that may happen, you can go in for exceptions. You can push the deal. You can present it the right way, right? So the platforms that are trying to create the even bigger disconnect are missing even more so out of that. And just really, it feels to me like the people that are doing that are just trying to lay off more work onto actually borrowers themselves, who are actually getting the same deal and probably not even, as good a deal otherwise. So.
Yeah, it's interesting. I totally understand what you're saying in that, and this is from my own personal experience of working with different lenders. And I think something I undervalued when I first started going out to get loans was the importance of being able to tell that story about each individual deal, because different than on the residential side where, a house is kind of a house, right? If you're talking about just primary homes and things, each commercial property is very unique, has a different story, a different angle to the business plan. And if you don't give that context, I think that can all be missed if you're just looking at the financials and just saying, okay, here's what the pro forma looks like. And you can miss out on a lot of opportunities because of that. I think both trying to get a loan that you need and also on the lender side. And I think if you can really tell that story, you'll have much better success. So I totally understand what you're saying and needing to really have that context around the numbers with commercial deals.
Yeah, that's right. And I'll tell you, I've seen that kind of, platform technology, again, I'll say platform, really being pushed recently, and the disconnect getting bigger. And we're kind of just, not reacting to that, but just pushing even more so into the other direction, into the model that, you know, where it's like we bring the borrower and lender relationship side as close as possible, and it just works so much better.
Hmm. Yeah, no, that's really interesting. It's definitely a unique model.
Mhm.
So switching gears a little bit, I want to get some, just get your thoughts on a few things, being so close in the industry. One is just like how have you seen lending change over? And I mean, we talk. I guess I mean more from like a loan structure terms standpoint, because we just talked about kind of how the industry is moving. But how have you seen that change over the last couple of years? And like, what are you seeing now as kind of more the norm from where people are getting loans and what type of terms or type of loans they're going for?
Yeah, I mean, so, you know, specifically keeping a multifamily, you know, I mean, it does, lending never stopped, right, during the pandemic, right? So let's talk like 2019.
Hmm.
2019, you know, I would say, you know, the overarching theme there was lots of competition to try to get loans, right? Especially in multifamily. You had lots of lenders out there chasing loans. Leverages were getting pushed very, very high. You know, credit spreads, right? So the credit spread is seen as basically the risk premium on the deal. So that, like, that spread, whatever it is, 150, 200 basis points over the index, right? Those were getting squeezed even further, right? And then going into right before the pandemic, it was extremely competitive, right?
Hmm.
And lenders were competing against each other. Then the pandemic hit, right? And so, and this will kind of play into the theme. You know, the pandemic was basically a risk off type of, you know, environment. So, you know, and whenever you have uncertainty in the marketplace, that's going to happen, right? And two things are going to happen. Lenders are going to get more conservative, and credit spreads are going to widen out, right? So when the pandemic hit, leverage came in, right? And lenders got more conservative, and credit spreads, that risk premium, came back up. So I think a lot of the lending that people were doing during 2020, you know, let's say at the bottom, was lower leverage, credit spreads were a little bit wider, stuff like that.
Hmm.
Now we basically have rewound back to, you know, kind of the ramp up from the financial crisis, that, but it's much faster, right? So, you know, if you kind of look at, you know, the money supply that the Fed created, we created, I think, the same amount of capital, that like M2 capital that's out there, in about 2 months that we did in about 5 years after
Hmm.
2008, right?
Yep.
So just the amount of liquidity that's in the system that is going to get lent out, and, you know, and looking for a home, is significantly higher. So that ramp up from, you know, the risk off, you know, environment to the risk loving environment is, you know, almost completely back. So what I've seen back in the marketplace is, you know, more private lenders and CLO type, you know, lenders, you know, coming back in the marketplace. Leverages are getting very, you know, getting way back up there again. And then the, you know, credit spreads have come in a bit, or excuse me, a lot since 2020. Now we're talking while the Ukraine war is going on, right? So that's
Hmm.
another risk off type of environment, right? So credit spreads did widen out a bit, but candidly, I just don't see that, you know, affecting, you know, any sort of LTVs that anybody's going to do, you know, here whatsoever. They did widen out CMBS credit spreads a little bit, so we have seen a little bit of that. But generally speaking, what I'm seeing in the marketplace today is just a lot of appetite and a lot of liquidity to get deals done, but also with the backdrop of knowing that, you know, assets are very expensive, and
Yeah.
multifamily is expensive, right? And you know, and so we do a lot of work in the JV equity space. And some of these JV equity guys can kind of be like, you know, the first canary, right, to kind of tip off like where the rest of the industry ends up going, because they're in the equity space, right? And it's, you know, the first risk, right?
Hmm.
And what we've seen in, you know, the joint venture partner space is, especially like, let's talk about like value add multifamily deals.
Sure.
I've seen a lot of pushback from JV guys about the low ingoing cap rates, regardless of where it's going, right? And say, well, I'm going to pop rents to this after we, you know, do this capex and renovate this many units. And like, yeah, but it's a 3 cap going in,
Right.
right? So you know, I've seen a lot of pushback from that. And then a lot of the JV money go actually more towards new construction, versus existing value add stuff because you're actually getting better premiums there. So again, lots of liquidity, leverages are definitely creeping up, but I would say the idea of assets being very expensive is definitely out there. And then debt services in areas, where, they weren't so constrained before are starting to get more constrained. So in the West Coast, right, in California, you would see these extremely low cap rates and you would get, constrained to around 65% LTV because you're buying things at a 3 cap.
Yep.
I'm now seeing that in other areas, right? So on the East Coast and in some Midwest market as well. So, that's definitely definitely going on and people being aware of it. As far as what lenders are out there and being aggressive, it's kind of across the board when it comes to multifamily, right? There's your typical, the agencies, there's your tax dollars hard at work, right? Fannie and Freddie. Those are always going to be extremely competitive and liquid in the small balance space, but they do have disadvantages come along with them. The private space, especially when it comes to bridge lending, value add, even construction today. I'm doing several multifamily deals that are construction that are getting done with private lenders because they're willing to go up to 80 to 85% LTC. No bank is going to touch that, right? So I'm seeing a lot more, deals getting done in the private space, especially in construction because construction costs have gone up so high, right? And then, the banks are certainly still here, but they do have difficulty competing with those two sources, construction on leverage and then agencies on long-term fixed rates. So.
Yeah, no, I appreciate that overview. And that's it's similar to what I've seen and when I talk to other operators, kind of the trend toward more private lending, more bridge loans, like folks that were doing Fannie or Freddie, long term, like the standard 10-year fixed, 3-year interest only type thing, or
Yeah.
I mean, have moved more to 2 to 3 year bridge loans, right? With the plan to refinance. And I think needing the extra leverage on the front end to remain competitive, just because of where pricing is and because of all the capital you talked about, all the people chasing deals. I mean, there's a couple of deals I was recently involved in, bidding after, where we had more than 30 offers, coming through the first round. And so I think debt being the largest part of the capital stack is your best way to differentiate. If you can bring down your cost of capital or increase your leverage, you can stand out. You can pay the higher price, right? You get the returns that you need.
Exactly. When it comes to the long-term fixed rates, it's difficult in today's environment to go into a deal, especially in an agency deal that's going to have very restrictive prepayment penalties, and say, I 100% know what I'm going to be doing 5 years from now. I don't need to pay it off, right? Because you have so much uncertainty out there, and also you have a lot of inflation that's out there that people haven't dealt with before, right? And let's just say you get into a deal today, you have it locked up on a 10-year fixed rate, and inflation's 10% a year. Okay, over 5 years, that's a lot of equity potentially that is accessible in that property, but you're locked in. So you're not wrong. I am seeing people, maybe, not take the low, interest rate, long-term fixed rates because it gets them locked into it, and then go with something that's a little bit shorter term, 3 years out, and then reevaluate or recap, or maybe even sell then because, things are moving so quickly today. So I think, I definitely think, what's driving people in these areas is, take on a lot of leverage because there's a lot of inflation, right? And the debt that I take on today is going to be worth, what was inflation today? 7.8%, I saw. 7.8% less to that lender next year, right? And then kind of stick to shorter term strategies because there's so much uncertainty.
Yeah. That's absolutely what I'm seeing too, just from an operations side. And, how do you, just being so close to the markets, what are you seeing as you look at, whether it's looking at futures or looking at what, news that's coming out? What are kind of your thoughts on where we go over the next couple of years? Interest rate wise, I guess.
Oh man. So, all right. I used to trade interest rates for a living. Okay.
Yeah. I feel like you're the guy to talk to.
There is, who knows, man. I can make, You
I'm
can
looking
make
for
it.
your crystal ball.
Yeah, that's the thing. And this is what I try to tell people too. They're like, should I lock my rate today? I mean, they're pretty good rates if you want to lock them in, right? But the thing about interest rates is there's so much that goes into them, right? I mean, you're talking about GDP reads, money supply, geopolitical stuff. I mean, now we have a war. Okay, if Putin just like threw his hands up and said we're done, rates would go up. If it escalates even further, rates will go down. Okay, I mean, if somebody can tell me what he's going to do, then I can tell you what rates are going to. You know what I mean?
Right, right.
So there's just so much uncertainty out there right now. I mean, I think generally, if you look at our country and the economics of what's going on here, right, and the inflation we have, if you look and get rid of everything else, yeah, rates should rise, right? And the Fed has said that rates are going to rise. But I don't know. The things you don't know what's going to happen tomorrow, right? I mean, oil might go to $200 a barrel tomorrow, and that's going to be a huge, headwind on our economy. And then I don't think rates rise, because I think that that takes out kind of the steam that the Fed wanted to take out.
Sure.
So there's a lot of stuff just going into here, and what I tell people today is you gotta go into this thing, seeing where rates are today, being comfortable with that, and protecting your downside, right? I mean, if you're going on a bridge loan, buy a cap. If you're figuring out how long to lock in an interest rate, though, don't worry about where interest rates are going to be in 5 years. Worry about your strategy, right?
Yeah.
Am I getting out of this thing in 5 years? Okay, give me the lowest rate today that protects me for that period of time.
Yeah.
You know what I mean?
And
go ahead.
I was just going to say, and what I often think heavily about is what's the prepayment structure, right? And how do I limit the I'd rather pay up on rate to limit my prepayment on the back end, to have that flexibility, because like you said, you just don't know, and you want to be able to to be opportunistic around market timing if you're a seller. I mean, that has so much to do with it. So so yeah, I mean, I agree with you. I appreciate your perspective on that there's so many, I mean, I recognize there's so many moving pieces, but the idea, I mean, inflation, I think, is one of the main drivers, but there are things, I think a lot of people are just certain, or at least that I've talked to recently, are just certain rates are going up, going up, going up. I think what you're saying is that there's a lot of other factors. You got to look at things that could take, like you said, the steam out of the economy, that where we wouldn't need to raise those rates. Right. And so I think it's just, I mean, there's so many factors to look at, but it's not necessarily set in stone, I guess.
I mean, I think this is my humble opinion.
Yeah.
I think a lot of people are focused on the wrong equation of the interest rate idea, right? Because, I have a lot of discussions about this, and people are saying, well, where are rates going? Where are rates going? How to figure it out? We're not interest rate traders. We're real estate guys, right? Mm-hmm. And candidly, it doesn't matter where interest rates are going. What really matters for our decisions is cost of capital today and what I can do with it. And the real idea to look at here is, what's your real cost of capital?
Right.
Right. And when you think about, if I do a loan at 3%, but inflation is 8%, what am I really paying for money? Negative 5%.
Yeah.
And that's the way to look at the real estate equation, right?
Mm-hmm.
And I think you transact as long as it makes sense. And that's why I was telling people, people, I don't think this has hit a lot of people yet, because, look, I'm 38. I haven't lived in an inflationary environment before. And I don't think most people that are, 38, I certainly know they haven't, but most people in real estate really haven't, right?
Right.
And it just hasn't hit you, because you've heard your whole life, don't take on debt, don't take on debt. Less debt is good. Yeah. Well, I don't know. If I'm getting paid to take debt today, sounds pretty good to me. You know what I mean? And it's what I've been telling people, like, I'm not telling, people go get credit card debt, but like where it makes sense, and, and if you can make it work, I would say take on as much debt for these projects as you can, because what's going to happen is even if nothing changes in your deal and inflation continues at 8%, next year, that property is worth 8% more, but the debt to the lender is worth 8% less. So save your equity, take on more debt, maybe keep it a shorter term strategy and then reevaluate later on, because you can only pay attention to what you can control, right?
Right.
And nobody has a crystal ball about where rates are going. So you just focus on your cost of capital today and where it makes sense. And that's how I try to explain to people, like, should I transact today with rates? Yeah, probably. Yeah. Right. Because I think, you're going to have, you have that hindsight looking back 5 years from now and say, shit, man, that property looked expensive, but I should have bought it. So.
Right. And I think that's what a lot of people are trying to reconcile right now with prices continuing to go up and in many markets reaching historic levels. But at the same time, so are the drivers of value, right? Inflation, rent growth, I mean, even wage growth, I mean, are increasing at levels that we haven't seen in a really long time. And
Right.
so those things that are going to drive the value on your property are increasing maybe more than the value of the property. I mean, it's tough to say. And then you start to look at things like replacement cost and cost of construction, and that also is through the roof. So you can't build that thing today what you could have built it even a year ago for.
Oh,
And
no
so,
way.
and
Yeah.
so you start thinking about all these different variables and trying to put them all together. I mean, debt, I think, like you said, thinking about your total cost of capital, really important. I like the perspective you gave on how to approach that and not just focus on what that absolute like rate number is. And also I wanted to highlight something you said earlier about, one thing I wanted to talk about with you, which you highlighted a little bit on, is just, how do you take some risk off the table, especially if you're looking at variable rates and maybe shorter terms, things like that. And I think one thing you said was buy a cap. And so maybe everybody doesn't know what that means. So like what is that, and how do you go about if you're going to buy an interest rate cap?
Right. So in most bridge loans, right, especially CLO bridge loans, they'll actually require you to buy a cap. So a cap is, if you're doing a deal like this and you're floating over, I guess it's going to be SOFR now, right? Not LIBOR.
Yep.
You're going to go to a third party, like interest rate hedging type of firm, and you're going to pay them a nominal fee, right? I don't know what it was based on, the interest rate that you pick is the cap, and then the principal of the loan, right?
Yeah.
And what that'll do is that will cap the potential rise and increase of your index rate, right? So let's say you get into this deal and you're like, all right, well, we need to buy a SOFR cap, and I want my SOFR cap to be 3%. That doesn't mean that your rate is capped at 3%, right? So if you've got that, let's say 400 spread over SOFR, your cap is if SOFR goes to 300, right? If it goes 3%, you bought that 3% cap, right? So potentially your rate could go to 7%, but then after that, the cap would kick in. That would be the most you would pay, right?
Yeah.
So, I mean, it's a good way, to kind of hedge like a worst case scenario, or if you wanted to pay up even more, you could get that cap all the way down. Right?
Yeah. I mean, what's the right way? Sorry, I mean to cut you off.
No.
What's the right way to evaluate? Because I mean, should we cap it at 400? Should we cap it SOFR at 200, at 300 basis points, at 400? What's the right way to evaluate that when you're looking at a deal? Like where should we?
Yeah, no, I'll tell you that it's a good question, and the answer is it depends on who the borrowers are and the strategy of the deal, right? Because it's kind of like saying, hey, what's a good investment? Well, I don't know. It's different for everybody else, right?
Yeah.
The way that these caps will work is, the market is expecting certain rises in interest rates, right? And based on those, the closer you get to those, right, the more expensive the caps will be, right?
Yeah.
So it's a probability equation at a certain level, right? As you get further down, the probability of the Fed hiking the Fed funds rate and SOFR coming up, because SOFR's short-term rate, right? I mean, they will become more expensive. So there's going to be a cost benefit equation you're going to have to do. And I would say, just get a menu of options from whoever the provider is, and then kind of make that judgment call. But also, again, it depends on, who you are, right? Because
everybody's risk tolerance is different.
Right. And then how long you're going to be in this thing, right? I mean, if you're going in, you're like, I need this bridge loan for 12 months, I'm not really that worried about a cap, right? But if this is a 3-year strategy and you don't have much liquidity outside of this thing. And, I don't know, I'd think about a cap. The other way, the best way to mitigate this, candidly, is by really making sure that you're buying the right deals. Because that's really what it comes down to, right?
Sure.
Because yes, rates will go up, but if you did the right homework, and the local economics of where this property is, you got the right demographics going for you, the economy where it's located is doing well, even if rates rise, you're going to do well. But if you're buying a deal that's kind of on the brink, and a lot of the underwriting was probably pushed, and it was like kind of pure pioneering, and some of your underwriting is based on rents that aren't available in the market today, that's going to be the bigger way to take on risk, right? Than just worry about the interest rate cap. So, I mean, that number one, it's the deal, and double checking the homework, and that your assumptions are already in that marketplace. I think that's the best way to mitigate all this risk, interest rate stuff.
Yeah, no, I appreciate that. I think that's a good perspective, and important for people to hear. I mean, it really is. Yeah. First, start with just buy a good deal, right? And then, the debt and everything will fall into place. I mean, we're still in an environment where debt is historically quite low.
I mean, it kind of goes back to what I said before, like lending is competitive. And just because a lender is willing to lend against your deal at very high leverage doesn't necessarily mean it is the same risk profile as another, you know what I mean? Like, I wouldn't, and I think some people do this too. Like they kind of like, oh, well, this lender is going to do it, and they back checked it, so it must be a great investment. Not necessarily. I mean, not necessarily, right? So.
No, I mean, case in point is like you think about back in 2006, 2007, and they're, I mean, more on the residential side maybe, but they're, you're giving loans 100% leverage, interest only type things. Like, just because the lender is going to do it doesn't mean it's the right thing to do.
Right. Yeah, I remember a friend of mine got approved for a mortgage back then. I think he made like $4,000 a month, and his mortgage payment was going to be $3,000 a month. And he was like, "How am I approved for that?" Like, and I remember Johnny the banker was like, "I don't know, but you are." So yeah, so, okay.
Yeah, but the word of caution doesn't mean it's the right thing to do. I think that's a good message. So one other thing I wanted to hit on as we're talking about things, just from your experience, for folks that want to, for folks that are out there, maybe they're newer, they're getting started, but they're getting out there and they want to get loans. I mean, how can folks show up in a way that's going to make them be taken seriously? I mean, what should they have ready to deliver? How should they approach, maybe the brokers or different lenders? I mean, what are some tips you can give to people?
Specifically to people that are going into markets they don't know, or maybe first time they're buying a multifamily property or something like that. I always tell people the first place you should go is call around to local property management companies. They know the markets. They know these properties well. They know the corner that these buildings are on. You know what I mean? They might even manage them, right? They know all the local players. They know the insurance companies that do this stuff. They know all the guys that are going to do the work on these buildings if you need it. And candidly, and I say this a lot to people, I'm like, if you're coming from managing 5 homes as rental properties, you cannot manage an apartment building. Like, I'm sorry, like, you need experience doing that. Get them for your property management company at first. And then, and maybe, contact property management companies, maybe even use one, right? And get some intel. And another great reason to contact property management companies is a lot of times you've identified the right market. A lot of times they have buildings for the people they're managing that, they might sell, right? So it can be a good way to find off-market properties. There's just so many resources you get, because they're kind of a consolidator of all the players in the local market, for these types of properties. And I feel like a lot of people purposely avoid them because, like, oh, I don't want to pay them 8%. Like, well, but just at least like interview them, talk to them, get to know the local markets, and because you don't know what you don't know. And you know what I mean? Like, you might be looking at some property and they're like, oh yeah, well, XYZ happened, and that's a corner that there's a drug dealer on every day, and yet, you know what I mean? But You didn't see that when you drove by it. So you can get a
Right.
lot of local intel going that route first. And that's, I don't hear a lot of people say that, but that's what I always say. Just talk to local property management companies. You're going to get so much value out of just even getting to know them.
Yeah, use that to educate yourself, and use that education then when you're talking with your lenders, and when
Exactly.
you're putting the plan together, because you're going to come off so much better, right? I think
You're
that's good
going to be
advice.
so much more versed in that local market and in that property.
Mhm.
Absolutely.
Yeah, Jake, that's good advice. So before we let you go, I want to take you through our keys to success round. I got 4 questions I want to ask you.
Do it.
First one is, if you were going to invest your money with somebody else and you could only ask them one question before you sent that check over, what is the one question you'd want to ask them?
How much money do they have in it?
Yeah, that's a good one. You got to have skin in the game, right?
That would be my number one question. If it was 0, I'm out.
Yeah, right. Yeah, I mean, makes sense. It's one of those things. It's like, man, I think you should invest in this deal. Like, I'm not going to, but I really think you should.
Yeah, well,
That never
right.
made sense to me.
So right. So I've seen deals where it kind of just looked like somebody was creating a job for themselves, right? And in that alignment of interest, right? And even to like the JV stuff that we do and everything. I mean, it's a huge point that I've just learned over the years, that the deals where there's alignment of interest work out 99% more than the deals that maybe don't. So.
Sure. Yeah, no, it makes a ton of sense. What are you most proud of in your career?
I would say seeing this company through the difficult times in the beginning to actually get over that hump. So here's a good way to explain it. I feel like in every venture that you do, right, there's a learning curve, and there's a certain point where you are screwing up so bad and so often that you just learn not to do that, and every single way to not do that, and then you just start making the right decisions. Right. You know what I mean? So
yeah, you just make every mistake, and then all of a sudden you're out of mistakes.
There's so many mistakes. Only so many mistakes you can make at a certain degree, right? But I mean that's going to be everything, right? I mean, I don't sit down, at the piano and not make mistakes. I'm gonna screw up nonstop, and then eventually,
absolutely.
But I feel like and this is probably right in every business. The business will work out, and there are entrepreneurs that are around for 15 years, right? Like we've been. You push through that, right? You can't give up, just because just when you feel like it's the worst point is where you're going to be screwing up the most and it not working the most. But usually that's right before it actually starts working.
Right. Yeah. And I've heard a lot of others say that. And I think there's a lot of truth there. So yeah, awesome advice. What is a book that everybody should read?
I'm going to be publishing ebook in like a couple weeks, so that one when it comes out.
Is it a to be determined name yet? You got a name for it?
I'm still doing a little research, but I think we're just going to put it on our website. It's basically like, what I realized isn't really readily available out there is just kind of like a very good general, almost like guide through capital markets, raising equity, joint venture equity, kind of explaining things really well. And then and then also included in that is like ways to find deals as well. And this is all just kind of stuff that I've seen other people do throughout the years, right? And then also, the stuff that I see in the capital markets and kind of explaining the different players, and then also kind of like forward trends that we see happening over the next 5 years.
Sure.
So
very good. Well, it'll be a few weeks before this episode's out. So when that comes out, send it over to me and we'll link it up for everybody. So the magic of technology, it's down in your show notes below. Go and click it, and you guys can get that ebook.
Cool.
And last but not least, what is your number one key to success?
Kind of going back to, I guess, the second question, right? I mean, don't be afraid to fail and make mistakes. And that ties into so many things, right? I mean, so many people are like the way I started this business, right? I started making calls. I started making cold calling people nonstop. And if I was worried about, failing or saying the wrong thing or screwing up, it would have paralyzed the whole thing, right? So just realistically, like, know what you want to do, put effort into it, and don't be worried, if you screw up, right? I mean, if you go into the gym, you don't start throwing around 100-pound dumbbells day one, right? You got to work up to it, So, I mean, don't be afraid to fail and just put the effort into what you're doing. And eventually you'll have made enough mistakes to the point where it'll start working. So.
I think that's great advice. And with that, so Jake, if people do want to get a hold of you, and they want to know more about what you guys are doing at Clopton Capital, how can they reach you?
You can hit me up on LinkedIn, very easy to find, or website, cloptoncapital.com. Call me directly. We're always around.
Awesome. Well, thank you so much for coming on the show and sharing your knowledge. And I hope you have a great rest of the day.
Appreciate it. Likewise.